Welcome to Seven Bulls. We break down finance so that anyone can understand. Roll the intro.
Hello, fellow investors. Welcome to Seven Bulls, a We Grow affiliate. Today, we're exploring the key distinctions between retail and institutional investors. Whether you're just getting started in the market or are a seasoned pro, understanding these differences is important. The big boys movements do affect the way the market moves. Before we move on, if you could hit that like button and subscribe, it helps us grow the channel and get into this algorithm. Much thanks. Now back to it. Before we explore the internal distinctions, let's establish the basics. Retail investors are individuals like you and me who invest their own money in financial markets. On the other hand, institutional investors represent large organizations managing funds on behalf of others, such as pension funds, mutual funds, and hedge funds. Now let's look at the external differences between retail and institutional investors. One of the main contrasts is the scale of investment. Retail investors typically invest smaller amounts of money, while institutional investors deal with significant sums, sometimes in the billions. As a retail investor, you might be investing through your personal brokerage account. You have the freedom to make decisions based on your individual preferences, financial goals, and risk tolerance. Institutional investors, on the other hand, operate on a much larger scale. They often have a team of financial experts, analysts, and portfolio managers who collectively make investment decisions. These decisions are typically aligned with the overall objectives of the institution and its clients. Now, let's go into the internal differences between these two investor types. First off, retail investors usually rely on public information, news, and online research platforms for their investment decisions. Institutional investors, however, have access to extensive research teams and resources, allowing them to conduct in-depth analyses, access proprietary data, and engage in thorough due diligence. Retail investors often engage in more short-term trading and may be influenced by market sentiment. Institutional investors, with a longer-term perspective, can implement complex trading strategies, including algorithmic trading, options, and derivatives, to optimize their portfolios. When retail investors buy or sell, it usually has a minimal impact on the market. However, large trades by institutional investors can significantly influence stock prices, creating ripples in the financial markets. Understanding the differences between retail and institutional investors is essential for anyone navigating the financial markets. Whether you're making decisions for yourself or considering how broader market movements might impact your investments, knowing the dynamics at play can give you a valuable edge. If you found this video helpful, don't forget to hit that like button, subscribe for more content, and don't be afraid to leave a comment. Until next time, keep up with your financial education. We're the only ones in charge of our futures. Be safe.
We grew.